The yield curve is a graph that shows the relationship between interest rates and the maturity dates of debt, usually government bonds. It's an important tool for understanding market expectations about economic growth, inflation, and interest rates. By analyzing the yield curve, investors and policymakers can gauge the health of the economy and make informed decisions. The curve typically plots bond yields on the vertical axis and maturity periods on the horizontal axis. For example, it compares the interest rates on short-term bonds, like 3-month Treasury bills, with long-term bonds, such as 10-year or 30-year Treasury bonds. The shape of the yield curve reflects how investors view the future of the economy. There are 3 main types of yield curves: normal, inverted, and flat. A normal yield curve slopes upward, indicating that longer-term bonds have higher yields than short-term ones. This reflects a healthy economy, where investors demand higher returns for locking their money up for longer periods. For example, a 3-month Treasury bill might yield 1%, while a 10-year bond yields 3%. This suggests optimism about future growth and moderate inflation. An inverted yield curve slopes downward, meaning short-term bonds offer higher yields than long-term ones. This is often seen as a warning sign of a potential recession. Investors expect economic growth to slow, leading them to demand higher yields for short-term bonds as they anticipate lower interest rates in the future. For instance, a 3-month Treasury might yield 3%, while a 10-year bond yields 2%. A flat yield curve occurs when short-term and long-term bond yields are nearly the same. This suggests uncertainty in the economy, often during transitions between periods of growth and slowdown. The yield curve is influenced by factors like interest rate policies, inflation expectations, and investor behavior. Central banks, such as the Federal Reserve, play a significant role by setting short-term interest rates. For instance, if the Fed raises rates to combat inflation, short-term yields might rise faster than long-term yields, flattening or inverting the curve. Investors and policymakers closely monitor the yield curve because it has historically been a reliable predictor of economic trends. For example, an inverted yield curve has preceded every U.S. recession in the past several decades. It signals that investors expect lower growth and are shifting their money into safer, long-term bonds. In summary, the yield curve illustrates the relationship between bond yields and maturities, serving as a powerful indicator of economic expectations. A normal curve reflects economic confidence, a flat curve signals uncertainty, and an inverted curve warns of potential recession. Understanding the yield curve helps investors, businesses, and policymakers anticipate changes in the economy and make informed financial decisions.